I want to start with the fact that honestly kept me up a little bit last night because it just doesn't make sense on paper.
Okay.
If you look at European banks, generally speaking, they are significantly less profitable than American banks. Like, if you look at their return on equity, it's basically half of what you see on Wall Street.
The pretty stark contrast when you just look at the raw spreadsheets.
Right, but here's the part that breaks my brain. If you look at the portfolio performance for 2025 and, start of 2026, betting on those less profitable, seemingly boring European banks didn't just work.
Wow.
It massively outperformed the U.S. giants. I mean, we are talking about a significant gap.
It is the classic torture of the efficient market hypothesis. Sometimes, the boring, regulated, lower return asset is exactly the one that skyrockets when everyone is staring at the shiny object in the room.
So, welcome to another Blueprint to Escape case study. This is officially episode 2 in our series of 5 episodes focusing entirely on geo-diversification.
We're on a mission here.
We really are. The mission for this specific case study is pretty clear. We are generating a guide for Canadian and U.S. investors on exactly how, and more importantly, why to diversify outside of North America.
And today, Europe.
And specifically today, we are shining the spotlight on the European market as we move deeper into 2026.
And just a quick nod to the prerequisites. If you missed episode 1, I highly recommend hitting pause and going back.
Yeah, you really need that foundation.
It laid the foundation on the why of non-North American investment and gave a big picture recap of the markets. Today, we are zooming in. This is the spotlight on European banks.
And stick around because coming up in the series, we've got Latin America for episode 3. We're doing a deep dive on broad developed markets and the IEFA for episode 4. And episode 5 is going to be a community suggestion.
That's right.
But right now, let's go to Europe.
Let's do it.
Okay, I want to go back to that contradiction I mentioned at the very beginning because I need you to help me reconcile this. You look at the data in this case study, and European banks seem, well, sleepy feels like a polite word. Sleepy is a polite way to put it compared to the U.S., yes. If you look at the fundamentals, there is a massive structural difference. The average return on equity, or ROE, for large European banks sits around 4 to 5%.
Okay, pause there. Return on equity. In plain English, that's basically how good the company is at turning my investment into profit. Right?
Exactly. It's the efficiency of the profit machine.
So, 4 to 5%. How does that compare to the big dogs in New York or the banks in Asia?
Well, U.S. and Asian banks are consistently hitting 9 to 10%, sometimes higher. So, on paper, the American banks are literally twice as efficient at generating profit from their capital.
See, this is where I get stuck. If I'm an investor and I have 2 lemonade stands and one makes $1 for every $10 I put in and the other makes 50 cents, why on earth would I park my money in the slow vehicle?
Why buy the bad business?
Exactly. Why buy the bad business? That is the knee-jerk reaction. And it's why so many American investors ignore Europe entirely. But here is where it gets fascinating. That lower profitability isn't necessarily because they are bad at business or don't know what they're doing.
Okay.
It is directly linked to lesser risk-taking.
Meaning they aren't swinging for the fences.
Meaning they aren't allowed to.
Yeah.
European banks are operating under a very different set of rules compared to the U.S.
We're talking about government regulation here.
Heavy regulation. Since the financial crisis years ago, European regulators have been incredibly strict. They require banks to hold much higher CET1 ratios.
CET1. I see that acronym in the case study a lot. Let's unpack that. What does it actually mean for the bank manager sitting at his desk?
Think of it as a safety cushion. It stands for Common Equity Tier 1. It's the core cash and equity a bank has to hold in its vault against the loans it makes. The higher the ratio, the bigger the cushion they have if the economy crashes and people stop paying their mortgages. European regulators require a much thicker cushion than the U.S. does. So for every dollar they lend out, they have to keep more money idle, just in case.
I see.
That makes the banks safer. Yes, they're less likely to go bust. But holding all that idle capital depresses their returns. They can't leverage it as aggressively to juice their profits.
So it's a trade-off. You get safety, you get a fortress balance sheet, but you lose some of that explosive growth potential because the money is sitting in the vault instead of working.
Precisely.
Oh.
But there is also a cultural difference here that the case study highlights. It's about how the actual economies function.
How so?
Well, Europe has what we call a bank-centric economy.
Versus what we have here.
Versus the U.S., which relies heavily on capital markets. Think about it this way. In the U.S., if a big company like Tesla or Apple wants to build a new factory, What do?
They usually issue stock or sell bonds to investors.
Right, they go to the market. They don't usually walk into a Chase branch and ask for a $10 billion loan.
Right.
But in Europe, that is exactly what happened. Yes. Whether you are a family buying a house, a small business buying a van, or a massive conglomerate building a plant, you go to the bank. The bank lends you the money. It stays on the bank's books.
And the banks are doing all the heavy lifting?
They are the absolute central nervous system of credit. They are essential to the daily economy in a way that U.S. banks aren't, even if their stock market valuations lag behind. They're almost like utilities.
Okay, so I get the picture. We have safer, utility-like institutions that are central to the economy but make less money. I'm still waiting for the sales pitch here, though.
All right. Yeah.
If I'm a North American investor sitting in Toronto or New York or Chicago, why do I care? Why do I want safe and slow when the U.S. market has been a rocket ship?
You care because of the 3 pillars of diversification. And if you are building a blueprint to escape, you cannot ignore these. The first one is simply different cycles.
Meaning we aren't moving in lockstep.
Exactly. European banks are driven by the Eurozone economy, the UK economy, and the decisions of the ECB and the Bank of England. Those entities do not copy-paste what the Federal Reserve or the Bank of Canada are doing.
But hold on. I always hear that globalization means everything is connected. If the U.S. economy catches a cold, doesn't the whole world usually sneeze?
Historically, there is truth to that. But look at 2025. The U.S. hit some specific speed bumps issues with commercial real estate, tech valuation wobbles. Europe was on a completely different trajectory.
So it's about decoupling.
It reduces your volatility. If your whole portfolio is tied to the U.S. interest rate cycle, you have a single point of failure.
Which brings us to pillar number 2, low correlation. And I guess this ties into what you just said about the specific risks.
Right. Studies in the case study consistently show that adding European equities to a North American portfolio improves your Sharpe A ratio.
That's the risk-adjusted return. Basically, how much return I get for every unit of ulcer-inducing stress I have to endure.
That is a great way to put it. And it improves because the risks are different.
Right.
You mentioned U.S. commercial real estate. Those empty office towers in San Francisco and New York.
Great.
That has been a massive headache for U.S. regional banks.
Huge. Some of them got crushed.
But European banks have different funding structures and different sector exposures. They aren't immune to pain, of course, but they aren't feeling that specific pain. So by owning them, you diversify away those specific regional nightmares.
Okay, I can buy the safety argument. But let's talk about the wallet. The third pillar, the price tag. Because this is where the case study really leans in.
The sale price. This is the value investing argument. Because of that lower ROE we talked about earlier, that inefficiency, European banks trade at a massive discount.
Yeah.
We are talking about 7 to 8 times forward earnings.
And for context, what am I paying for a U.S. bank?
Usually 12 to 15 times earnings.
Wow.
So you are paying almost double for the same dollar of earnings in the U.S. But the real kicker is price to book value.
I see this metric used for banks a lot. Explain it like I'm 5. What is book value?
Okay, imagine a bank closes its doors today. It sells every building, collects every loan, pays off every debt, the pile of cash left over.
Yeah.
That is the book value.
So it's the liquidation value, the scrap value.
Essentially, yes. Now, European banks are often trading at 0.5 to 0.7 times book value.
Wait, do the math for me.
It means if the bank has $1 of cold, hard assets, the stock market is willing to sell it to you for 50 to 70 cents.
That doesn't make sense. Why would anyone sell $1 for 50 cents?
Because the market is pessimistic. It thinks the bank won't grow or regulation will strangle it. But for a value investor, that is a dream scenario. Compare that to North America, where you were paying $1.50 or $2 for that same dollar of assets.
So in the U.S., I'm paying a premium for future growth. In Europe, I'm buying the assets at a discount.
Exactly. And because the price is so low, the dividend yields are significantly higher. We are seeing yields in the 8 to 12% range.
So you are basically getting paid to wait for the market to realize it made a mistake.
It gives you exposure to the value factor. If you own the S&P 500, you own a lot of growth tech, AI, chips. European banks are pure value. It balances the portfolio.
All right, so that's the theory. Theory is great, but I want to talk about how this actually looks in a portfolio.
Yeah.
The case study sources highlight a very specific vehicle for this. It's an ETF called EBNK.
Evolve European Banks.
Right. And looking at the stats for February 2026, this thing is a beast. But I want to understand how it works because it's not just a vanilla bucket of stocks.
No, it's a bit more engineered than that. EBNK tracks the top 20 European banks, but it does two things that are crucial for the strategy we are discussing. First, it is Canadian dollar hedged.
Okay, let's pause on hedge, because usually if I buy a stock in Europe, I have to buy euros first.
Right.
If the euro tanks against the dollar, doesn't my investment lose value even if the stock goes up?
Normally, yes. That is currency risk. Hedged means the fund managers use derivatives to neutralize that currency movement.
Ah.
So if the euro drops, you don't
Oh.
care. You only care about the performance of the banks themselves.
Got it. So it removes one variable. Now, the second feature is one that caught my eye. It uses a covered call strategy.
This is key for the income lovers.
But covered calls can be confusing. How would you explain it to someone who has never traded an option in their life?
Okay, think of it like real estate. Imagine you own a really nice rental house worth $500,000. You want to make extra money on it.
Uh-huh.
You find a buyer who says, I really like this house. If the price goes up to $600,000 next month, I want the right to buy it from you.
Okay.
You say, sure, I'll give you that right.
Yep.
But you have to pay me $5,000 cash right now for the privilege.
So I pocket the $5,000 immediately.
Exactly. Now, if the house price doesn't hit $600,000, you keep the house and you keep the $5,000. That $5,000 is the premium.
And if the house price skyrockets to $700,000?
Then you have to sell it at $600,000. You miss out on that extra huge gain at the very top. You capped your upside.
So I'm trading the moonshot potential for guaranteed rent money today.
Exactly. EBNK does this with about 33% of its portfolio. That strategy generates a lot of cash, which allows them to pay out a massive yield.
And that yield is?
Currently, EBNK is yielding around 11%.
11%, that is. Well, that's hard to find anywhere else without taking crazy risks.
It is huge. And the price has increased about 35% in the last year since the accumulation phase started.
But here is the aha moment from the data. When you look at total returns, that's the price going up, plus that 11% yield being reinvested.
Yes.
The comparison to North America is shocking. I actually thought these numbers were a typo when I first read them.
It completely flips the narrative of boring Europe.
Lay it out for us.
Over the last year, EBNK delivered a total return of roughly 60%.
60.
Now compare that. The equivalent Canadian bank covered call ETF ticker bank did about plus 40%.
Okay.
Which, to be fair, is a fantastic year.
Sure, I'd take 40% any day.
But look at the U.S. The U.S. banks covered called ETF ticker call was up plus 16%.
Ouch. So the hot U.S. market got smoked by the sleepy Europeans.
And the S&P 500 covered call ETF was up about 12%. So the European banks outperformed the U.S. banks by nearly 4x in this specific strategy over the last year.
That is undeniable outperformance, and it really validates that point about cycles you made earlier.
It does.
If you were sitting there thinking U.S. financials are the only game in town, you missed the bonanza.
Exactly. And we should look at what is actually inside that ETF, because people hear Europe and they might think of one specific country's problems. But it's remarkably diverse.
I'm looking at the breakdown here. Britain is the biggest chunk at about 20%, France is roughly 16%, and Spain is right there at 15.5%.
And those aren't just random allocations. Those are the heavyweights. You have BNP Paribas and Société Générale in France. You have Lloyds and HSBC in the UK. And you have the Spanish giants, CaixaBank, and Santander.
Which brings us to the heavy hitters. I want to get specific because averages can hide a lot. We have data here comparing these specific European giants against the North American titans, specifically JPMorgan and TD Bank.
This is where the story gets really granular. If you look at the last year, only one North American bank really kept pace.
Who was it?
TD Bank had a great run, up about 74% total return.
TD had a monster year.
It did. It actually beat BNP Paribas, which was up 54%. But look at the other side. Lloyds Banking Group, the British stalwart, was up 90%.
90%. For a British bank.
Compare that to the king of Wall Street, JPMorgan.
Yeah?
JPM did about plus 20%.
So Lloyd's crushed JPMorgan.
Crushed. But the real star of the show, and this is a major focus of our case study, is Banco Santander.
Spanish giant.
Santander put up a total return of 129%.
Hold on. 129% in a year.
Oh, yeah.
For a bank.
I know.
We aren't talking about a crypto coin or a Silicon Valley startup here. This is a regulated utility bank. How is that mathematically possible?
It sounds impossible, but it was a perfect storm of three things. First, record profits. In 2025, they posted a $14.1 billion profit.
Wow.
Remember those high interest rates in Europe? They finally flowed through to their bottom line. boosting margins massively.
Okay, so they were making money hand over fist.
Second, strategic execution. They have this plan called One Transformation.
See, whenever I hear things like one transformation, I assume it's just corporate buzzwords for a PowerPoint presentation.
Usually it is. But in this case, it actually worked. They ruthlessly cut costs. They got their efficiency ratio down to 41.2%.
What does that actually mean, efficiency ratio?
It's simple. How much does it cost you to make a dollar? Santander is submitting 41 cents to make a euro of revenue.
Right.
Compare that to some bloated legacy banks that spend 60 or 70 cents. They digitized, they streamlined, and they became a lean machine.
Okay, that's impressive.
And they used that cash to buy back $5 billion of their own stock. Shareholders love that. But the third reason is the most interesting for our geo-diversification theme. Market re-rating.
This is the Latam connection.
Exactly. Spain's economy recovered faster than expected. Unemployment dropped to around 10%.
Right.
But Santander isn't just a Spanish bank. They have a massive footprint in Latin America.
Right.
Investors realized that buying Santander wasn't just a play on old Europe. It was a backdoor way to get exposure to fast-developing markets in Brazil, Mexico, Chile.
Oh, interesting.
But with the safety net of European regulations.
That is a key insight. You are buying a European stock, but you are effectively investing in the growth of the global south.
Exactly. It illustrates why you can't just look at the headquarters address. You have to look at where the revenue comes from.
So we have the data, we have the specific wins, but I want to pivot to the philosophy of this. The case study discusses a concept called philosophy of ownership.
Yes, this is crucial.
The sources emphasize that you shouldn't just diversify for the sake of checking a box. You shouldn't just buy an all-world index and forget it. They talk about knowing what you own.
Right. The portfolio managers mentioned that they invested heavily in Europe and South America because they have roots there. They understand the culture.
And interestingly, they avoided Asia, even though we know there are opportunities there, because they said it is unknown to us.
That's refreshing honesty, isn't it? Most Wall Street types pretend to know everything about everything.
It is. But is that a good strategy? Investing based on vibes and personal travel?
It sounds subjective, but it brings up a huge psychological component. There is a pride of ownership. When you understand the companies, when you walk down the street in Madrid or London and see the bank branch you own shares in, managing the portfolio becomes real.
It's not just flickering numbers on a screen.
Exactly. And that engagement prevents panic selling. If you know why you own Santander, you don't sell it the moment it drops 5%.
Yeah.
You understand the business. You stick to the plan.
Now let's talk about how this fits into the pie, because I don't want anyone listening to think we are saying sell everything, dump your U.S. tech, and buy Spanish banks.
Definitely not. Please don't do that. In the model portfolio we are analyzing, EBNK makes up about 8% of the total.
So it's a slice, not the whole cake.
A significant slice, but balanced. They still explicitly state they believe in U.S. tech and Canadian financials as key drivers. Europe is the hedge. It's the income generator. It's the ballast that keeps the ship steady when the U.S. market gets rocky.
So let's wrap this up. If you had to distill this entire case study into one takeaway, what is it?
The main takeaway is that the narrative of U.S. exceptionalism, that the U.S. is the only place to make money, was flat out wrong in 2025 and 2026. European banks offered a unique combination of safety, incredibly low valuations, and massive performance.
And doing it through a vehicle like EBNK provided that high yield while smoothing out the ride.
Precisely.
Now, before we sign off, a quick reminder, this is just part 2.
Yes. Episode 3 is going to be fascinating. We are heading south to Latin America. Then Episode 4 covers the broad developed markets with IEFA.
And for Episode 5, we need you. We are looking for community suggestions. If there is a specific market or ETF outside of the US and Canada that you think we should deep dive into, let us know.
We want to hear what you're seeing out there.
And of course, the standard disclaimer applies. We are unpacking a case study here for educational and entertainment purposes. This is not financial advice.
No.
We don't know your situation. Do your own research, speak to a professional, and know what you own.
Always.
If you are serious about this, about financial independence, passive income, maybe even designing that nomadic life where you can spend time in the places you invest in, please subscribe.
And don't forget the monthly reveal.
Yes, around the 20th of each month, we do the monthly income portfolio reveal. We show the moves, the logic, and the results. It's transparent and it's real. So post your comments, ask your questions, and hit that subscribe button.
It's the best way to learn.
Expert, leave us with one final thought to chew on before we get to the Latin America episode.
I want to leave you with a thought on home bias. We all have it. We feel safer investing in our own backyard. But ask yourself this. If boring, unprofitable European banks can outperform the invincible U.S. market by such a wide margin in a single year, what other sectors or regions are you completely ignoring simply because they aren't in your neighborhood? What is the actual cost of your comfort zone?
That is a very expensive question. We will see you in episode 3.